Hello, everyone, and welcome back to Finance Does Matter, where we discuss the economics behind your money, especially focusing on the NRI group. Now, before we begin, I'd like to make an important disclaimer that this presentation is intended solely for educational purposes and should be viewed as a financial case study rather than any financial advice. Every investor's circumstances are different, especially when dealing with international taxation, foreign exchange considerations, estate planning, and real estate ownership. So I would recommend that you consult a financial advisor, tax professional, attorney, or estate real estate expert before making any investment decisions. So one of the most common questions I receive from many NRIs living abroad is whether they should buy a property in India. For many NRIs, owning property back home feels almost like a financial milestone, and it should be. It's an aspirational, goal. Many of us have grown up thinking and imagining that one day we'll own a property of our own, and it provides a sense of belonging, security, and perhaps a future retirement options. And as a finance professor, I believe this question is often approached emotionally rather than financially. And the question should not be whether I should buy a property in India. The better question is buying property today the best use of my capital compared to all other available investment opportunities? So today, let's break it down in a more logical manner as to answer this uh, very important question that many of the NRIs deal with when they are settled abroad. So why are NRIs attracted to the Indian real estate? So there are several reasons why Indian real estate remains attractive to the non-resident Indians. First, obviously, is emotion. India is home. Many NRIs eventually hope to retire in India or maintain a long-term connection with their roots, or they so desire, to retire in India. Now, eventually, that happens or not happens is a different story, but uh, there is that connect. There is that emotional connect. Now, second is familiarity. Most of us have grown up hearing that land and property are among the safest investment available. Uh, and interestingly, when I started my journey as an NRI and came to the United States, I was actually surprised that real estate could be, volatile in terms of pricing. That there could actually be a slump in real estate pricing. Growing up in India, I'd always thought that real estate only goes up. It does or never comes down. And the fact that the land itself uh, has only a notional value abroad compared to India, where the land has a much more value than compared to the actual constructed, property. A lot of differences were there. So, but nevertheless, a lot of interesting facts and comparisons or comparables, which made it rather interesting. And third is history. So between roughly 2000 and 2015, cities like Bangalore, Hyderabad, Pune, and uh, Gurgaon or Gurugram have experienced significant appreciation. Many investors have generated wealth through real estate during that period, and we've heard, stories where these properties have exponentially uh, grown in value over the last decade. So there is obviously, all these factors that continue to attract NRIs towards an investment in real estate, and rightly so. However, finance teaches us that past returns do not guarantee future performance, and good asset does not automatically make a good investment. So even excellent assets can become poor investments when purchased at a wrong price or when superior alternatives exist and when we have not done our due diligence. So one thing that I'd like to talk about is the hidden costs. Especially when you're buying a property in India, when you compare that to purchasing of a property abroad, where the transactional value is almost given to you on day one. The breakups are there on that lengthy piece of paper where you get a breakup of what the actual value that you're paying, plus all the registration, legal fee, inspection fee, other fees. So to the last dollar, plus or minus, maybe $100, $200 here and there, exactly upfront how much money you're spending. However, when you talk about the costs of purchase of property in India, uh, that's a mystery, really. So one of the biggest mistakes investors make is focusing only on the advertised property prices. And I think what the authorities in India need to take an action or note of is to provide some safety net or safeguard to investors to really start also advertising the pricing or give an approximate of the pricing that would be kind of an out of the door, in case of vehicle purchase. Here's on the showroom price and then out of door price. So there are two different things. Same thing for properties. Some law should exist or some disclaimer or disclosure should exist. So suppose a builder advertises an apartment for 1 crore rupees. Many investors assume that 1 crore is going to be their investment, or mentally they're thinking, okay, 1 crore plus minus, maybe a couple of lakhs here and there. Unfortunately, that is rarely the case. In India, buyers often encounter several additional costs. You have the stamp duty, you have the registration charges, and then there are GST on under construction properties, which can add up a lot. Then there are, the PLC fees, where, for example, you'd like to get a park facing, you want the apartment on a certain floor. So all those add up, and there are parking fees, club membership charges, infrastructure charges. You have the generator backup, those charges, maintenance deposits, legal costs. If you're taking a loan, then there's a loan processing fee, and nowadays when you take a loan, then they also want to get you to undertake a insurance to yourself that is tied to the loan, and the policy is held by the bank, and the restrictions are such that they ultimately get you to pay the premium for their sort of a associated firm, which is kind of overhyped in terms of pricing. So in many cases, these financial acquisitions costs can be anywhere between 8 and 20% higher than the advertised prices. So make sure that you have asked about all of these extra costs, and then you make up your mind as to what your investment is going to be. So that difference significantly impacts investment returns and is often ignored during the purchase decision. Now let's examine a practical example, and I'm just giving you some hypothetical examples. So suppose an NRI purchases an apartment advertised for 1 crore rupees. At first glance, the investment appears pretty straightforward. But however, after you've included the 6% stamp duty, give or take, 1% registration charges, the GST, the parking fees, maintenance deposits, the club membership fees, legal expenses, and loan related costs, the actual investments can easily reach approximately 1 crore and 19 lakh rupees. So think about that. Just pause and think about it. You now have a situation where you had locked yourself with some advance payments you made for an apartment, thinking it'll be 1 crore, and now you have almost a 20% extra fees and charges that you end up paying. So the amount of capital committed is almost 1 crores and 20 lakhs. So your starting point of that investment is not 1 crore. It is actually 1 crore and 20 lakhs. So from a finance perspective, your investment starts at 1 crore and 19 lakhs and not 1 crore. The property must appreciate substantially before you even recover your acquisition costs. So, that's kind of your input costs, and then long term, if you are trying to assess the return on your investment, it should be based on 1.2, not 1, crore. That's going to be your purchase price. So most property advertisements never really discuss this reality. So another challenge that most NRIs face, especially when you're living in the US, the Canada, Australia, and most of the European countries, is how do you actually pay for these properties? The challenge is basically, um, firstly, of course, is the searching for the property. You typically don't have the time. You rely on your word of mouth. You look at advertisements and so forth. Friends, family, they recommend, and that is going to be your first starting point. And if it's a property that's being developed, you have no idea how and what it'll turn out to be. You'll have your fingers crossed till the last day when you sign the document and actually purchase the property and move into it, unless you realize where you purchase what. So historically, some real estate transactions also involve, both officially recorded payments and unofficial cash payments. So for example, a property advertised at 1 crore may involve 80 lakhs through official channels and 20 lakhs through cash. Now, for local investors, this may occasionally be manageable. I'm not pointing fingers, but I'm just, basing or reiterating the facts. For NRIs, it's often not. Income earned abroad is generally fully documented, tax reported, and bank traceable. So most NRIs cannot simply produce large amounts of undocumented cash. And many transactions in India still, even though the government, it's a lot of credit to the government for trying to uh, create those electronic means of payments and clean up the channels of payment. There still is a lot of this undocumented work that's going on, and that may still continue for some time. So while this is absolutely incorrect approach legally and ethically, it can reduce the number of available opportunities and sometimes increases the acquisition costs, because where do you find the idea, or the amount that's being requested or being asked to be paid in cash. So when does purchase of a property make sense? Now, despite everything we've discussed so far, property can absolutely be a good investment. I mean, don't take me wrong. I'm not here to say that investment of real estate in India is a bad decision. So first condition is that you're genuinely intending to return to India. If you expect to retire in India within the next 5 to 15 years, then the property serves not only as an investment but also as a future housing security, because having a good property in a nice neighborhood or a apartment complex can be really challenging if you really just showed up and said, I need a property in next month or so. So second condition is attractive rental income. Many residential properties generate rental yield of, in reality, the seller might say, okay, you might get a great rental yield, but check on it, because yields of only 2 to 3% is what you really get. That you should be clear about it. But certain commercial properties or specialized locations may offer stronger cash flows. But that is a whole different ball game. It'll require a constant and vigilant, sort of a uh, scrutiny of what the property and where the property is. So third condition is location. So property appreciation ultimately follows jobs, infrastructure development, migration patterns, and economic activity. And finally, property should represent only a part of your overall wealth, not the bulk of your overall wealth. So diversification, remember, remains important regardless of how property may appear, how that investment of property may appear. It still should be focused on your condition and not your friends or family or somebody you've heard made an insane amount of return on a property investment. So when does the property investment does not or may not make sense? So property may not be right investment if you're uncertain about returning to India. And then again, it's not an advice. It's sort of a case study. So think about that. So it may also be unsuitable if rental yields are low and your investment thesis depends entirely on future appreciation. Because remember, when you have rental income, that is an income that has to be reported not only in India but your future for but also on your tax document uh, of wherever you're living. And secondly, these properties generally have ongoing maintenance, so a good bit of that rental that you collect is going to get into the rental, the property maintenance charges, which the RWA would assess on your property. Uh, and there are ongoing, maintenance and repairs that might need after the first year or so. So if you lucked out and got a great builder who made you a nice property with good material, then you may not need that kind of ongoing maintenance. But let's say you are in a zone or in a climatic conditions where you might need a lot of repairs and all other maintenance work, then that's a continued hassle. So you have to look at all those factors. So third is obviously liquidity. It would remain a concern because property selling is not entirely as easy as you might think. And again, when you get into sale of property back home in India, and you want all of that money to be under the documented channel, that is a deal breaker, believe me, for a large number of offers that you might get. I mean, what are you going to do with the undocumented cash that they might offer? Um, so think about those um, aspects. So unlike stocks and ETFs, selling a property can take months or even years. And the market conditions in India fluctuate a lot, in different zones. So that is another discussion. So you may not have access to your capital when you need it. There are also ongoing responsibilities, including maintenance, repairs, society fees, taxes, and tenant management. And real estate can create wealth, but it requires patience and active involvement. I mean, if do you have the time for it? Yes. Okay, fine. But if you think that it is not something that you can deal with while you work abroad, or you may not have an active participant in India who can constantly be looking at the property, like your parents or somebody that you can trust, then it may not be a good investment. So one thing that I keep coming back to is the electronic traded fund alternatives. So I'm just going to take it as a case study. Whether you start out by investing in property and then on a same situation you have the same amount invested in an ETF abroad where you're living. Now, which one gives you a better return? So let's discuss this alternative. If you've watched this channel before, I'm a strong believer in ETF, and that doesn't mean in any case or any way that property is bad. It simply means ETF solves many problems investors face. And personally, I've learned this hard lesson uh, and I've seen my friends and family learn this hard lesson where obviously we get emotional about property purchase, but then you learn by, your mistakes, or you learn by experience. Let me put it that way. So it simply means ETFs solve many problems the investors face or have the dilemma to really give you the time to make up more, uh, or invest in a better alternative, or invest at the right time. Let me put it that way. So firstly, it's simple. With a few clicks, investors can gain exposure to hundreds or even thousands of companies worldwide, and it's become so easy for investors who are residing in the US or Canada, European countries, Australia, and so forth. And secondly, the liquidity. I mean, ETFs provide liquidity. You can generally buy or sell during market hours whenever your circumstances change. And it's almost as simple as a click of a button, when you buy and sell. Third, ETFs are very cost effective. Many broad market ETFs have extremely low expense ratios, often less than 1/10 of percent annually. Some of the uh, I don't want to name any uh, ETF creation companies, but if you just search some of the big names in the ETF business, they do a wonderful job of creating these ETFs and maintaining and managing them with very little cost involved. So investors in countries like the US, Canada have access to ETFs covering nearly every investment theme imaginable. I mean, do I simply just make a no sophisticated investment with a complete market? Yes, you have index that tracks S&P 500. You have index that tracks, the semiconductor sector. You have one index that tracks the finance sector. You have one index that tracks healthcare sector, the real estate sector. I mean, you name it, and there are sectors after sectors after sectors that can be tracked. So there are broad market indices in existence. You have international markets, you have artificial intelligence, you have semiconductors, cybersecurity, healthcare, infrastructure, real estate, gold, bonds, and much more. So, personally, the combination of simplicity, liquidity, diversification, and low cost is why ETFs are my preferred wealth building, vehicle. So let's take that example, going back to that 1 crore apartment. So let's say if I were to purchase 1 crore rupee apartment back in 2010. Now at that time, the exchange rate was approximately 45 rupees to a dollar. So that means your investment represented approximately 222,000 US dollars. And we're not even talking about those extra expenses, those maybe 19 lakhs more. We're not even adding that to this right now. So now assume the property doubled in value and is worth 2 crore rupees today. On paper, uh, it's very gratifying. At first glance, that sounds like an excellent investment. However, today's exchange rate is approximately 94 rupees to a dollar. As a result, the property is worth only about 233,000 US dollars. So think about it. After 16 years, the dollar value of investment has barely increased. Now compare that with a Vanguard VOO, which simply tracks S&P 500 index. And if you let it glide autopilot with dividend reinvested over the same period, an investment in VOO would have increased many times over. In fact, over 8 times over, while providing liquidity, diversification, and flexibility through the journey. Now, the same 222,000 would have been valued at $1.73 million if you did nothing. If you did not touch that fund, let it auto glide did not withdraw, did not sell, did not buy and sell, like, sometimes we get the urge of playing the market, you would have had that funds. And then when you're really ready to buy a property back home, which would be better? Would have been better to purchase an apartment back in 2010, or would have been better to leave that money invested in the stock market or the capital market in ETF, no sophistication, very little expense, and then when you're ready, withdraw funds, pay your taxes on capital gains, which is now long term, so low taxes, not the same high tax on the short term capital gain, and purchase a property of your liking. I mean, if you purchase the same property at 233,000 today, you would have saved almost what, 1 million, even after paying taxes and everything, uh, with the same amount of money that you initially began to invest back in 2010 in purchase of a property. So again, my final thoughts. Let me conclude with my personal philosophy. If I were an NRI investor today, I would continue building wealth through diversified ETFs while maintaining liquidity and flexibility. And again, I'm saying, if I were, this is not a financial advice, this is my philosophy. I would not rush into purchasing properties simply because everyone says NRI should own real estate in India. Now, I know it's very hard. It's very hard because you have parents' pressure, you have peer pressure, you have other pressures, not just in India, but in US or other countries, where you have the pressure to show or demonstrate that you're successful and hence you should purchase a property. That is fully understandable, but instead, I would allow my investment to compound. When I know where I want to live, when I know I will actually use the property, and when the purchase aligns with my financial plan, I would simply sell part of my portfolio and make the purchase. My philosophy is straightforward: let your money work for you first. Keep it diversified, keep it liquid, and buy property when your life genuinely requires it, not years before. Because imagine the huge opportunity cost you would have lost out if you only got, X amount of return by investing in property when you didn't need it versus when you really needed it, but you lost out on all the compounding for your capital. So, successful investing is not about owning most assets. It's about allocating capital where it creates the greatest long term value. Again, thank you for watching. And if this video gave you any benefit, or if you enjoyed this analysis, please like, share, and subscribe to Finance Does Matter, because understanding the economics behind your money truly does matter. And I'd love to hear from you about what else you'd like to hear about. And I'd love to make, those contents. And thank you for encouraging me. We started slow, but I hope that we'll move fast. Thank you so much.